Imagine you put your life savings in a bank on Tuesday. By Friday, the bank is gone. The building is still there. The sign is still there. But the money is gone. There is no insurance. There is no government backstop. There is no one to call. The teller who smiled at you on Tuesday is home unemployed, trying to explain to his own family where his savings went. Now imagine this does not happen once. It happens to 9,000 banks over 4 years. And the people it happens to are your great-grandparents. That is not a nightmare. That is 1933. So this is the story of how roughly half the banks in America disappeared, why the government eventually made it a federal crime to own gold, and why an entire generation spent the rest of their lives convinced that the safest place for money was a mattress. By the end, the mattress will make perfect sense. And you will understand exactly why Grandma still does not trust the bank manager. In the summer of 1929, America was in what everyone agreed was the greatest boom of all time. Stock prices had tripled in 5 years. Newspapers ran stories about shoeshine boys giving investment tips. Economists on the radio explained that the business cycle, the old pattern of boom bust, had been solved by science. The banking system of that era looked nothing like today. There were around 25,000 commercial banks. Most were small local and lightly regulated. Most were owned by men who also owned the general store, the grain silo, and half the farmland in the county. If you deposited money, the bank handed you a little book and a promise. The promise was that your money was safe. The promise was backed by the bank's reputation. The reputation was backed by the bank's assets. The assets, in many cases, were loans to local farmers whose wheat prices had just fallen by 40%. You see where this is going. Deposit insurance did not exist. The Federal Deposit Insurance Corporation, FDIC, the thing that today guarantees your deposits up to $250,000, would not be created until 1933. Before that date, if your bank failed, your money was gone. Not frozen, not partially recovered. Gone. Vanished. The kind of gone where the only thing left to do is write a very angry letter to a man who has already moved to Florida. This is the world your great-grandparents woke up in on October 24th, 1929, a world in which everyone assumed the sun would rise, the boom would continue, and the bank on the corner would be there forever. It would not. The Wall Street crash of October 1929 is the part of the story everyone knows. Stocks fell. Rich people jumped out of windows. Actually, historians now agree that the jumping story was mostly exaggerated, but it makes for great newsreels, so the myth survives. The crash wiped out roughly 30% of stock market value in a few weeks. Here is the part most people miss. The crash was bad. The crash was not what caused the Great Depression. The crash was the opening act. What turned a bad recession into a decade-long catastrophe was something much quieter, much slower, and much harder to make a movie about. It was the banks. To understand why the banks mattered, you need to understand what a bank actually does. Here is the whole thing explained the way an 8-year-old would understand it. You give the bank $100. The bank puts maybe 10 of those dollars in the vault. The other 90 the bank loans out. To a farmer, to a factory, to your neighbor buying a car. This is called fractional reserve banking, meaning the bank only keeps a fraction of your money as actual cash and lends the rest. It works beautifully as long as not everyone wants their money back at the same time. In 1930, everyone wanted their money back at the same time. It started in small farm towns. A bank in Tennessee failed, then a bank in Kentucky, then 3 banks in 1 week in Arkansas. Word traveled by newspaper and by the thing that moves faster than any newspaper, which is your neighbor running down the street shouting. When people heard that a bank had failed, they did the rational thing. They ran to their own bank and asked for all of their money, immediately, in cash. This is called a bank run. And here is the dark joke at the heart of banking. A bank run will kill a perfectly healthy bank. The bank does not have everyone's money in the vault. It has 10%. If 100 people show up demanding $100 each, the bank can pay the first 10. Everyone else gets the closed door and a sign that says suspended operations, which is the banking industry's polite way of saying that your retirement is now a bedtime story. In 1930, about 1,300 banks failed. In 1931, another 1,700. By the end of 1933, roughly 9,000 banks, more than a third of the entire system, had collapsed. $7 billion in deposits evaporated. In today's money, that is around $160 billion. Roughly the GDP of Ecuador this year gone from the pockets of American families over 4 years and nobody coming to refill them. Now here is where things get interesting. You would expect the Federal Reserve, the central bank, the entire institution whose job is to prevent exactly this, to step in and flood the system with cash, stop the panic, save the banks that were actually healthy. That is what central banks exist for. That is literally the one thing on the job description. The Fed did the opposite. In October 1931, after Britain abandoned the gold standard, the Fed actually raised interest rates. Not a little. It nearly doubled them in 2 weeks, from 1.5% to 3.5% at the exact moment the economy needed the opposite. Why? Because the Fed was worried about protecting America's gold reserves. It prioritized a metal over the citizens. In the 6 months after that decision, roughly 2,294 banks failed. It was the single worst wave of bank failures of the entire Depression. An economist named Ben Bernanke, who would one day become Fed chairman himself, later called this period the greatest policy mistake in Federal Reserve history, which is a diplomatic way of saying our own central bank helped set the house on fire, then raise the price of water. So picture your great-grandfather in 1931 watching his third bank in 2 years close its doors. Tell him the banks are safe now. Go ahead. Try. By early 1933, the system was in free fall. Entire states began declaring bank holidays, forced closures imposed by governors to stop runs by simply not letting anyone get their money out. Michigan closed every bank in the state, then Maryland, then Ohio, Indiana, Arkansas, Illinois. By the first week of March, banks in 38 states were either fully closed or operating under severe withdrawal limits. The economy of the most productive nation on earth was effectively operating on personal I owe us and trust. On March 4, 1933, Franklin Delano Roosevelt was inaugurated as president. He had been in office for roughly 36 hours when he did something that had never been done before in American history. He closed every bank in the entire country at the same time. It was called the National Bank Holiday. From March 6 to March 13, 1933, no commercial bank in the United States conducted any business. Zero. You could not deposit, withdraw cash, a check, or transfer a dollar. The largest economy on the planet was running on the money that happened to be in people's wallets on Sunday night and nothing else. So what did people do? They invented money. More than 100 American towns and cities printed their own emergency currency known as scrip. It was printed on whatever was available: cardboard, paper, leather. In the small town of Tenino, Washington, the local Chamber of Commerce printed scrip on thin sheets of wood veneer, stamped with the town seal. You could take a wooden 25-cent note to the grocer, buy actual bread, and the grocer would take it because everyone had agreed in a kind of collective handshake that the wood was money until the banks reopened. Those wooden dollar bills still exist. Collectors trade them today for thousands of times their face value, which is more than you can say for a lot of stocks from that decade. Now remember Grandma, she is young, maybe 10 years old during the crash, 15 during the bank holiday. She watched her parents' handbags of coins to a bank teller receive a little book full of numbers, and then watched that little book become wallpaper. She watched the United States government admit for 1 week in March of 1933 that it could not guarantee any bank in the country would still be there by Monday. She watched the grocer take wood as payment, and then just to finish the lesson, she watched the government come for the gold. On April 5, 1933, Roosevelt signed Executive Order 6102. American citizens were required by law to surrender almost all their gold coins and gold bullion to the Federal Reserve at a price of $20.67 per ounce. The penalty for not complying was a $10,000 fine, roughly $250,000 today, or 10 years in federal prison. Within months, the government officially revalued gold at $35 an ounce. The Americans who had just handed over their gold at the old price effectively took a 69% loss overnight by government decree. Ownership of monetary gold by American citizens would remain a federal crime until 1974, 41 years. So, banks vanish, currency becomes wood, gold becomes illegal. And you are wondering why Grandma keeps a roll of 20s taped to the back of a picture frame. Here is what actually happened to the money under the mattress. Between 1929 and 1933, the overall price level in the United States fell by about 25%, which means something strange and easy to miss. If you had $100 in cash in 1929 and you simply held it, literally hid it in a sock by 1933, that same $100 would buy roughly a third more than it did before. Deflation quietly made cash one of the best performing assets of the Great Depression. Cash in a mattress earned no interest, but cash in a mattress could not fail with the bank. Cash in a mattress was not confiscated with the gold. Cash in a mattress did not have to be exchanged for wooden coins in an emergency. Cash in a mattress did exactly one thing, sat there, and sitting there as it turned out, was a strategy that beat most of the alleged professionals on Wall Street for the better part of a decade. This is what economists call precautionary cash demand. Regular people call it money in the coffee can buried in the backyard. The behavior was so widespread that when FDIC deposit insurance was finally introduced in June 1933, economists estimate that billions of dollars in private cash were sitting outside the banking system, hidden in homes. Much of it took years to trickle back in. Some of it never did. Some of it was found decades later by grandchildren cleaning out attics in coffee cans, shoeboxes, and yes, under mattresses. The generation that lived through this did not come out of it with a lesson about investment diversification. They came out of it with a nervous system. They washed out tin foil, they saved rubber bands, they paid cash for everything, they distrusted credit cards, stockbrokers, real estate agents, and anyone who used the word opportunity with a smile. And when the grandkids years later suggested that Grandma move the rainy day money into a high-yield savings account, Grandma looked at them the way a veteran looks at a civilian explaining war. Her nervous system was not broken. It was tuned for a world in which the bank was a building that might not be there next Tuesday. In that world, the safest return was zero. And the safest place was the one institution that could not be closed by a governor, could not be seized by a president, and could not fail overnight: her mattress. Here is the part that should haunt anyone who thinks this kind of thing cannot happen again. In 2008, when Lehman Brothers collapsed and the global banking system nearly seized up the Federal Reserve's internal emails, showed officials discussing the same fear from 1933, a system-wide run, banks going down in sequence, cash vanishing. The reason 2008 did not become 1933 is almost entirely that Ben Bernanke, the chairman at the time, had spent his academic career studying exactly what the Fed had done wrong in the Depression. He wrote the book, literally. He then became the person who was not going to repeat it. So the next time you see Grandma unfolding a crumpled 20 from an envelope in a kitchen drawer, do not laugh. She is running a backup system. She learned it the hard way. And she has never, not once, received a sorry your money is gone letter from her mattress.